All right. Well, it's 2 o'clock. Thanks everyone for bearing with us as we waited for a few more to join. I'm going to get started here. And so I just want to say thank you for joining us today. My name is Danielle Lalonde, for those who maybe don't recognize me. And I'm a product lead here at BBD. And I'm specifically a product lead for ASO. So you may have seen that I've done a few sessions. Maybe some have gotten to participate before. I'm pleased today to be joined by Jay Nadler, a fellow advisor of yours from NaviGuide Corp, who will help me in our discussions on administrative services only. Before we get started, there are a few reminders, just a quick few notes. First off, this webinar is going to be recorded. You'll receive a follow-up email with a link to the recording after the webinar. So if you have any questions or concerns about the webinar, you can also contact us at info@bbd.ca. We'll also be running a bit of a question and answer session after the main presentation. So stick around if you have any questions or you'd like to hear the answers to others' questions, and you can submit them anytime by typing into the GoToWebinar question interface. And we'll do our best to address them all today, but if there's any remaining, we'll make sure that we get back to you at the end of the webinar. So without further ado, I'm going to say let's get started. So today we're going to be discussing evolving from traditional insured funding to self-funded benefit models, and specifically talking about administrative services only, or ASO. First, I want to start by saying that when I say evolving from traditionally fully insured to self-insured, that I'm not meaning that ASO is necessarily better than a fully insured product. However, that over time, a one-size-fits-all to insurance approach has not worked for all clients, and that ASO was an evolution of traditional insurance to fill a gap that is needed for some clients. And because of the many different needs of your clients, we've prepared this discussion today to help you in having the conversations with your clients. And I hope that you do find some takeaways, no matter what your level of knowledge is for ASO. So let's just kind of cover over the agenda. So in our agenda today, the first thing that we're going to just cover briefly is the differences between funding models. The second thing is why the conversation is evolving. There's many different factors why ASO is becoming a bit more of a topic of conversation right now. And so I think it would be good for us to kind of cover off some of those points. And three, talking ASO to clients, which Jay is going to present some of his information and how he approaches that with his clients. The fourth thing is we're just going to cover off a bit between the risk versus reward. 5, some added securities to reduce risk. And then 6, moving forward and successfully running ASO. So first, let's just cover off the differences between fully insured and self-funded. So when you're talking fully insured, the insurer manages all of the risk. And what I mean by that is that whether the claims are over and above the expected premiums, the insurer would take on whether that's a gain or loss in their favor. Groups claims costs are expected to come in on or below a set percentage of premiums in order for them to either maintain the rates or have a low increase or decrease to the rates. Premiums per person are determined and paid monthly. So this is something that with a set cost for premiums, if you add new employees, you can expect that additional funds are going to be required for those individuals, and it's going to be set during a rate guarantee period. And one of the features that is good about fully insured is that the rates remain unchanged during that period, and there's no additional funds owed or owed at the end of that period. So with self-funded, the employer manages all or most of the risk. And what that basically means is that they're paying directly for the claims. So any gains and losses on that are the employer's to keep. 100% of the cost is claims and applicable administration fees and taxes. And when I say administration fees, obviously I also mean to include the commissions in that. Insurance costs of reserves or anticipated trends in inflation costs are actually removed from the ASO model. And then administration costs do not change for the benefit year or for the period in which they've been guaranteed. So there still is a bit of a guarantee there on certain features or certain rates. And then with self-funded, there are still elements of insurance that can be purchased as add-on coverage, such as stop loss or the travel coverage. So I just want to cover off that there's two main features of self-funded. We are focusing on administrative services only, but there also is healthcare spending accounts. And I do get a lot of questions asking what the difference is between these, so I thought I would just highlight it today. With healthcare spending account, you can possibly have some design features within a plan. However, it's usually a set overall maximum allowed per employee. It's not something that you can necessarily easily change throughout the year. Usually it's locked in for that benefit period year of how much is given to each employee. For either, and it can be covered off for a full range of health and or dental related expenses. Whereas with administrative services only, it acts more like a regular fully insured plan in that it usually has a fully defined health and dental plan. The related expenses don't necessarily have to have an overall set cost. So basically, as with the other plan, the individuals can pay, the employer can pay directly for those costs and not have limitations necessarily set on their employees for the year. And so when we talk about ASO, there's also two additional things to consider. There's two different ways of funding the ASO model. One being non-budgeted, so basically it's a pay-as-you-go billing on the claims, and then it would include the administration fees and no more or less. So the only other thing that you might have as fixed costs are the travel costs or possibly the stop loss costs, depending on how that model is set up. And you will see likely larger fluctuations in costs month to month. With budgeted, it's a pay monthly budgeted premium based on estimated claims. So what that means is usually you're taking last year's claims and determining what the single family rate should be for the employees. And usually you're billing that monthly so that the individual still have a set budget that they're budgeting for. And then at the end of the year, the extra premium collected is reimbursed to the employer if there was too much over allocated for covering the claims. And also in turn, if there's not enough that's been collected, additional funds could be owed by the employer. So the second thing that I want to talk to you guys about today is why the conversation is evolving. And I think these are a few main points as to why things are shifting. ASO is often deemed more transparent, and it does offer potential savings over fully insured plans. Also recently with the global pandemic, people are definitely finding that it's worth having the conversation in how things are funded, specifically with regards to some of the services not being able to be accessible to employees and whether employers should be paying any premiums during those times is often a discussion that's being had. With three, the flexibility and customization, we're going to cover off some interesting features about ASO that highlight maybe a little bit more flexibility and options than in a traditionally insured option. And then four, high cost drugs are also becoming of big concern, and there is some interesting features with ASO that can sometimes help with maintaining and helping those costs for employers. So first, let's talk a little bit about what your client is paying for in insured premium. So basically, you're starting with the anticipated claims for the group, service charges, which is the admin, any adjudication for covering the claims, and commissions. Then you also have your stop loss charges, which would only apply to the healthcare portion. You have trend and inflation charges. Sometimes you see these together, sometimes you see these separate on a spreadsheet. And then incurred but not reported claims, which are often added to the insured expected claims in order to cover off anything that is maybe not covered if there's a bit of a lag in coverage. So if you break down the math for what you're paying for an insured premium for $1 in a claim, and you will see that I also have done this for self-insured, and you will see that there's a bit of a lower cost even from the first dollar. But one thing to keep in mind here is that you've got these different charges. Even if you're starting on $1 claim as what's expected, you are paying a little bit higher in costs when it comes to insured premiums because there is a bit more in the risk charges added. There's also other elements that aren't included in the self-insured. One thing you'll also notice here is that the stop loss charge isn't necessarily just that 16%. So something to keep in mind that usually it is being charged on a lot of the additional fees, and you are paying a set cost when it comes to stop loss charges. So what I mean by that is it's already included in the premiums for health. So whether they need to use that for the health claims or not, they're going to usually have a fixed cost. So what your client is paying for in ASO self-funded. So you'll see that it's a little bit more simplistic. You're actually paying the claims for the group, the service charges, so that would include commissions, admin, adjudication. You would also, in addition to this, have taxes, of course, for both items, and your stop loss charges here. So one thing to keep in mind with stop loss charges on self-funded is that you might want to ask the question, is this a set fixed charge, or is this something that's only going to get charged when claims occur for drug or health expenses? And that's something to keep in mind when you're looking at stop loss coverage for your client. So what you're paying for every dollar with ASO self-funded. So you'll see it kind of works from the dollar up. So when you say that you're paying 15.99%, you're basically paying that directly on top of that dollar claim. You're looking at premium tax if it's in a certain province, and you're looking at service charges. So and that can vary very different from each carrier. But if you're usually looking, a lot of times you're looking at a range from 4 to 6% for commissions. You can request differently than that. And then admin and adjudication, you're probably ranging anywhere from 8 to I would say 15% on a regular average. So when you're looking at the claims experience, it's also kind of something to keep in mind that you're automatically looking at a higher claims cost for insured being put into the calculation costs. So the IBNR, which was the incurred but not reported, is a factor. Then you also have the inflation charges there. So the total claims actually look a bit higher than the estimated ASO cost of claims. And then if you look in comparison, even though the calculations are the same, you're actually paying a bit more in insured premium because of the way the calculations work. So with the compensation, you are looking at receiving a tiny bit more with that, also because the claims are being calculated higher. And then the administration fees, premium tax, and stop loss. So even with the stop loss, as I mentioned before, because you aren't paying stop loss necessarily on all of those additional factors as well, you're looking at a lower cost. So in this particular case, with that amount of claims, we're looking around approximately a 15% savings. This can vary depending on the group, and it really does vary also based on whether they're on target or not on target. But at the end of the day, even from the beginning, you are paying a little bit less per dollar for a ASO funding model. So let's talk a little bit how COVID-19 has impacted the conversation. So pay for usage is definitely more attractive right now to employers, because in some cases they would not pay premiums in times where services are not accessible to their employees. There could be concerns the opposite direction as well, that having that fluctuation in costs may be of more concern starting for an employer right now as well, not knowing what the monthly cost would be. There could be cases where the insured would actually be more attractable to those individuals. I know that there has been a lot of conversation, and one of the things that we're going to talk today about with Jay is about split funding. So some have decided that it is more attractive to start looking at dental as ASO, because there's a little bit less risk, and you're paying a little bit less off the bat. So that's something that we're going to just touch on a bit later as well. With flexibility, the extended termination ages, when I say this, in some cases, they actually allow for no termination age, so basically to retirement or maybe even past, depending on if they have a retirement class. Because the employer is paying directly for claims, you will see that there's a little bit more fluctuation in what they allow. There's sometimes more travel options with some of the ASO products, not in all cases. There's some drug management solutions that have been built into some of the ASO products, and it's easy modification to include items. So a lot of times, if an employer decides that they want to start covering a certain health benefit, or one of their employees approaches them saying that they need some support, and the employer decides they want to put that through, it's usually a bit more flexible in allowing for that. So now we're going to get into talking ASO to clients, and I would like to thank Jay for being a part of this. So welcome, Jay. Jay is a very active individual, as you can tell from his picture. He's been in the insurance industry for many years. And one of the reasons that I've specifically asked him to come today is that he's one of our top sellers on split funding. And Jay is definitely an advocate for ASO and having the conversation with his clients. Jay, are you still there? Yeah.
Yeah, I am here.
Okay, perfect. So one of the first things I thought I would ask you, Jay, is how do you determine who's a good fit for ASO and who you should be talking to?
Well, it's a conversation. So first of all, I believe that everybody should be educated on all their options. And so when I'm meeting with a client, whether it's the first time I'm meeting with a client or I've had the same client for 5+ years, we're going to have a conversation. We're going to have it every year. And that's going to be about how they're using their plan, what their expectations of their plans are. We talk about their internal finances, how they run their money, and we do math. I'm a big proponent of math, and I think everybody needs to understand insurance math, which is a little bit different than the math that we learned in elementary and high school.
Yeah, for
So,
sure.
so it's really just a conversation. And in that conversation, what I'm listening for are for clues or specific statements that people, for instance, need stability or have flexibility in how they can do things on a month-to-month basis.
Hmm. So in speaking about that, maybe what I'll do is actually share my screen right now for you, and if maybe you could show us how you go through that with a client.
Sure.
I'm just gonna switch over here.
So what I'll do here is I'm going to give you guys the Coles notes. I know some of you were in that ASO conversation that I did. When was that? Was that November? It was
I
November.
think it was, yeah.
And so this is the Coles Notes, very, very quick version of that. But I'll show you literally what I do with my clients. And currently, the way I'm doing it is, Danny, can you see my whiteboard up?
Yes, I can.
Okay. So currently what I'm using is Microsoft Paint, and I've got a computer that turns into a tablet. So I just draw pictures and they can see it just like you're about to see it. In the days when I could actually see people, I would actually have a white piece of paper that I would do this on. If they came to my office, I've got a whiteboard up on the office. So really what I do with people is a longer version of this. I say, here's how your premiums look, and this is a 12-month period. And every year the same thing happens. You start at $0 of claims, and one of three things happens from that point. Your claims are low, they're as predicted. This part here are your fees, or they're high. So if you're fully insured, this is profit for the insurance company. If you're fully insured, this is a loss for the insurance company. If this happens and you remain fully insured, your price might come down a little bit next year, it might stay about the same, maybe it'll go up a little bit. You're not going to see a lot of change. If this happens, this or this or this is deemed as your rough expected use for next year. There's a lot more to it than that, but just for the purposes of this conversation, that's roughly what the insurance company is going to think that you're going to spend next year, and they're going to adjust your price based on that. So if this happens, we already talked about what's going to happen. If as predicted happens, I just lost my drawing board. There it is. If as predicted happens, you're going to go up roughly with the cost of living. But if this one happens, you know where your price is going next year. Now, that in a world where somebody needs to know what they're spending every single month based on per person costs, that's fair. Again, there's a lot more to it than that, but that's what you need to know. Okay, so that's insured. Now, let's talk about ASO. What's the difference between insured and ASO? So something's going to happen. You're going to have a premium, and the premium isn't exactly the same, but for the purposes of this conversation, you're going to have a premium. You still have to pay for claims, and claims are going to start low, and they'll be low, they'll be as predicted, or they're going to be high. Here's the difference. If this happens, this here, that is your profit. If this happens, that is your loss. If this happens, well, that's predicted. These are your fees. So the first thing between ASO and non-ASO is that because you are taking on the risk, the insurance company doesn't have to charge you as much, because built into your admin fees is what I like to call a bit of a risk charge. Danny referred to it as the IBNR. I think there's actually a little bit more to it than that, but I know Danny is trying to keep things within an hour, because that one conversation is probably hours long anyways if you talk to an actuary. But anyways, so that's the first reason why it's going to cost a little bit less, is because we're removing those risk charges. The next thing that happens is what I call insurance math. Oh, and by the way, this amount here, you have a couple of options. If you're a small company, it's just pay as you go. And some insurers, BBD specifically, they're going to take a deposit, and every single month they're just going to pay your claims out of the deposit. And then at the end of each month, you're going to get a bill to refill your claim room and pay your fees. If you're large enough, there's an option for budgeted ASO. Budgeted ASO looks and feels just like a premium, unless this happens, in which you're going to get a call which says, you know what, we need to charge you more on a monthly basis for your budget, or you need a lump sum of extra to cover off on the extra expenses that are going through. So again, one way or the other, it's reactionary based on what we need. What I do with my clients is I say, listen, this is what you were paying when you were insured. We know you can afford that amount, so let's use that as your budget. Now, Danny spoke about a savings. So where's the actual savings mathematically? I'm gonna just get rid of this. So let's talk TLR. That's hopefully an acronym you're all aware of. The way I describe it very quickly is your TLR. Let's say you've got a 75% TLR. That means 75 cents of every dollar is going for claims, and the remaining 25% is your administration. Again, it's much more detailed than that, but for purposes of this conversation, that's what your TLR is. So the reality is that if only 75 cents of every dollar are going for claims in an insured model, that means that your actual admin cost is 33% of a claim. How do I get that? 25 over 75 is 33. So in this case, if you have a $1 claim, your cost is going to be $1.33. If we move you to an ASO at 20%, if you have a $1 claim, your cost is $1.20. Pretty much that easy. There's again some other features in there or factors in there, and it depends on which province you're in. But that, for the most part, is how I actually explain it to my clients. And my clients, when I was doing it on paper, a lot of times my clients would ask me for those pieces of paper, even though they were just covered in scribbles. So does that answer your question in a bit of a nutshell?
Yeah, that's great. So what I would say to that too is that it's great for people who learn in different ways. We could talk blue in the face about insurance all day long, but some people aren't going to necessarily understand until they see it visually. Some people wouldn't understand visually and need to hear it. So in combining those efforts, I think it's great that you're helping your client really see from different perspectives how that works. I'm just going to go back to.
So the other part of your question that I didn't get to there was, we were talking about split fund. And, if you sell life insurance, that means that, some of the premium is paid by the business, some is paid for by the employee. In this case, split fund would mean that if some of the concept is fully insured and some of it is ASO. So with my clients, I actually talk ASO to everybody. If they're 3 employees, I talk ASO. I want them to know their options. I want them to know as they grow that there are more things available to them. And the other thing that's going on in my mind is if I don't talk to them about it, somebody else will. In my world, I deal mostly in the smaller market, very, very few clients over 20 employees. And in my world, most of my clients over 10 employees have their dental as ASO and their health as fully insured. But when they do get larger, I do have one client now, I think they're at 11 employees, who is ASO. I have had, for everything, I have had clients of 5 employees who are ASO for everything. These are businesses who can afford flexibility in their monthly premiums, and they understand the concept, and they understand that 3 out of 4 years, they're probably going to be ahead if they go ASO than if they were insured. And yes, you have to make clear that there's always the chance that they may have been better off if they were fully insured, but that year that they would have been better off if they were fully insured, the following year they'd be far better off ASO. And there's very few exceptions to that. And I bet you if you go back and you look at the renewals with your clients, you'll find 3 out of 4 years they could have saved money.
For sure, that's a really good point. So one of the things that I also got to work with you on is a case study for one of your clients, and I know that we're also working on another one with one of your clients that's been interesting. But we're going to send this out at the end of this webinar so that everybody can have it and kind of see some of the advantages that this particular client has had with having the choice in having the split funding, having health through fully insured, and then dental through ASO. I guess one of the things I'd like to ask you too, Jay, is just in your experience this past year with some of your clients, have you seen any positive impacts to their funding because of the fact that there was some times where dental wasn't able to be utilized, and was there any positive results for those clients having ASO over fully insured?
Absolutely. Well, as I'm sure you all know, very few people went to the dentist March, April, May of last year into June. I still haven't gone to the dentist since all this started. I'm dying to go to the dentist, but I'm on the neurotic side of this whole COVID thing. So most of my clients are down. Some of my clients who were fully insured actually discontinued dental for that period of time. But most of my clients, well, everybody on ASO kept their dental running just in case there were emergencies. Most of my clients are down, well, last I looked was about August, September, I think, and they were running at about 10% of their prior year's claims. That was average. One of my clients was running almost normal, which kind of shocked me. Their employees through all of this were still going and getting their teeth cleaned, or they had a lot of emergencies. But for the most part, even that client, if they were insured, we'd be looking at a decent renewal next year. And what we're actually looking at right now is they're just under where they were the year before. So that's all good. Yeah, I think that answers your question, does it not?
Yeah, that's perfect. Yeah, that's great. So yeah, I'm going to move on to the next slide, and we're going to talk a little bit about or I'm just going to overview kind of what I had as takeaways from maybe your last ASO session that I got to be a part of with you in listening, and just basically lay it out visually to the client. There's more than one way to learn. For any client of the right size, make it part of the conversation and ensure that you have the conversation before someone else has the opportunity to present that option to them. So that was my main takeaways from what I've gathered in speaking to you. Would you say that that's pretty accurate?
Yep, yeah, and it is, what I was alluding to before as well. Like I said, I talk about this to clients as small as 3 employees.
Yeah,
And I always draw pictures. I always do math, and we always, of course, have a verbal conversation as well.
perfect. Well, I'm going to move on to our next session, but feel free to jump in anytime, Jay, on any of the slides or any of the discussion, and I may ask you a couple more questions as we go along. So now we're just going to talk about risk versus reward. And I know we've kind of touched on that a little bit. But one of the things that I liked, or a quote that I saw, is you miss 100% of the shots you never take. And this is actually something I guess that Wayne Gretzky said, but the Michael Scott from The Office stole it. So one of the things to consider is good risk versus bad risk, and there is such thing as good risk. So one of the things that it should be simple to understand if it's good risk, and the potential impact should be clearly defined and within the means of the employer to be able to handle. So they need to know exactly what they're getting themselves into and understand basically what the risks are. It provides a high probability of coming out ahead in the long run, as we've discussed, but there is the possibility that that might not be the case, and they need to know those options. So when you think of bad risk, I would say that it's usually complicated. There's insufficient history to really gauge the frequency and severity of the bad outcomes. So in some cases, um, depending on that individual's case, some may find that it's actually harder to know where they may end up because they don't necessarily have the claims history to kind of have that backing through the math, and so they may find that it's considered bad risk to them. Um, it has the potential for devastating impact. So that is one thing that you would consider bad risk. If it's something that they truly can't handle, it's something that you wouldn't necessarily want to put that on them, and you don't want it to become unmanageable for them to handle. So one of the things too is that budgeting for expenses and growth are important. So go over the financial costs that they could incur, determine their budget needs and what they have in access. And one of the things I took away from another advisor is that, let them know what their risk exposure. So if we're looking purely at a dental risk exposure here, if you had 10 individuals, and that includes dependents on a plan, if all made eligible claims up to, say, they had a maximum of 1,500, the total risk exposure is basically going to be 15,000 approximately. And then, of course, there would be the addition of administrative fees and taxes. But let's say their claims last year were 8,540. So you're looking at an average per person of around 850. You're going to look at what their projected claims would be. So I will tell you that most ASO, if you're looking at budgeting, there's probably a bit of a trend factor built in to help kind of protect those individuals' claims from the prior year, but they still are only paying for the claims they actually use in the end. So this does reflect a bit of a trend or inflation cost. And then the admin and taxes. So the actual estimated risk is approximately around $10,582 for this client, but they have the potential to have 15,000 plus in claims come through. So that is something that they need to be aware of. So let's also talk just a little bit about added securities and reducing risk. So there are a number of ways to do that. And I thought this quote was really applicable. The only real security that a man can have in this world is a reserve of knowledge, experience, and ability. And I think definitely knowledge is a big factor in making comfortable decisions. And so I thought that was a very profound statement. So, let's consider some ways that you can remove or minimize or transfer the risk. So you could look at limiting plan features, which is something you can do in fully insured as well. Stop loss protection, which is also in fully insured, and formularies, which also can be either in insured products or non-insured products as well. So if you're limiting plan features, I won't take too much time on this, but with drugs, it's obvious that you could either add a maximum or add a formulary to it to help reduce those costs. Paramedicals, you could look at reducing overall maximum or combine the maximums. You can put on per visit caps. Limit the practitioners, or for vision, you could reduce the amount or set up longer durations for setting up those funds. Jada, do you have anything to add here?
Yeah, just one thing on the last slide that wasn't there that people need to keep in mind is that if you're moving people from insured to ASO, one of the things they need to think about is credibility. If you've got a 10 life group, they might only be 50% credible. Is somebody willing to lose that and become 100% responsible for all of their expenses? And credibility can work for and against you, but it's an important part of the conversation.
For sure. Yeah, that's a very good point. So then also stop loss protection. So there's obviously a large range in threshold levels between insurers. Usually between 7,500 and 25,000 is what most commonly you're going to see. You can have the drug only or drug and EHC. I'm not very familiar, but some carriers may allow for EHC only, but I think that would be pretty rare. I think most cover the drugs off. And then other considerations that these are important questions to be asking when you're looking at the stop loss. Um, so consider threshold adjustments for individuals already in stop loss. So some carriers, and depending what you're looking at, you may actually receive an adjustment for that one individual, and the employer may become responsible for more of the costs. So that is something that you need to be aware of. They look at those on case by case basis, but there is some wonderful opportunities when people are in stop loss too, to be looking at ASO and looking at, say, sort of a drug management formulary that may help reduce that. But there's lots of considerations to take into effect when you're thinking about that. Um, so another thing to consider is when the carrier will pay out for high cost claims. So some carriers, depending on the type of claims, you may have to approach them early to get them to pay out on a high cost claim. So the employer may actually be responsible for that claim up until the end of their renewal. So that's something you want to keep in mind, that if all of a sudden they get hit with a high bill, what is that going to look like for them, specifically on the drugs in these cases. And then rate adjustments for plan limitations. So when you're considering this, you want to make sure that you're kind of getting the best out of the possible scenario for yourself. Are they reducing the stop loss fees based on adding some of these specialized features, or adding a drug maximum, because their risk is lowered? And just a little side note, if you are having some health plans, stop loss protection may be mandatory for some ASO health plans as well. So that's something to keep in mind. So then the final one is drug management formularies. And there's a lot of different ones in the market, but one of the things that I just want to highlight, kind of on a high level overview of these type of programs, but they help in the management of drug costs through numerous methods and drug listing considerations. Some eliminate unsustainable high cost drugs altogether. Others provide support services for employees in securing like alternate funding through, say, coordination of benefits, provincial drug programs, and manufacturer programs. And they often reduce costs for administration or stop loss charges, and can obviously lower the cost for prescription drugs for employers. So moving forward and successfully running ASO, if I can offer you any wisdom, is that make sure you know what's going on with the ASO. Help employers to budget or use a budgeted ASO so they at least have an idea of what their costs should be expected. Provide regular claims reports. Adjust the plan to provide for more or less coverage based on the usage. It can be easily done. Know what drugs are being utilized. If it's the right size of group, some information obviously can't be provided if it's a smaller group, but if they're of the right size, make sure that your carrier is providing that information for you. And prepare the employers if there is a spike in some sort of claim that you're seeing in that history. Jay, do you have anything to add here?
Yeah, I just have to say, one of the things that I really love about doing ASO, when you talk about helping people budget, is on renewal, it's no longer the insurer telling me and then me telling the client what the new price is going to be. It's now me sitting down with the client, showing them the math and having a discussion about where they want to set their budget. I'll have suggestions for them, but they actually get to have feedback and they get to say, you know what, we share with the employees, let's budget a little bit low and give the employees a bit of a break. Or, mentally, you know what, I'm going to budget higher. It's a fabulous conversation, and you learn a lot about people, how people, your clients, think about their money and their employees in that conversation.
For sure. Yeah, that was actually something too that I was just going to touch on with the renewal expectations. A lot of it is set fixed costs. You might be still having some fluctuation, but it's very limited. So the stop loss charges obviously could be reviewed, or travel costs, or the administration costs may be adjusted. But like you said, it is something that you get to have the impact on as to how the renewal really goes for the client. And I think that is a nice advantage. If they have a surplus, they could look at putting it back into the plan if they wanted. They have a numerous possibility of outcomes at the end of either having a surplus or deficit. If they decide just to pay off a deficit, they could possibly look at just keeping the rates the same for their employees if they want, if they're budgeting, or they basically can handle whatever costs they want to charge for that for their employees. So I definitely think it must be a nicer conversation in some ways to have when they get to have a little bit more choice in the matter.
Absolutely.
So I just want to say thank you to everyone for joining today. I'm just going to put up my contact information while we're kind of looking at answering some questions. So that can concludes our main presentation, and I will just check to see if there are any questions.
I don't see anything in the chat. Oh, there's
No,
questions.
it looks like they're. Oh, yes, I can send you the slides after the presentation. That is not a problem. Oh, sorry, these are really hard to read here. I'm going to try and expand this so I can read it better. Okay. So with HSA, can the employer take payroll deductions to support the cost, or must it be 100% employer paid? Usually it is required that it's 100% paid for HSA. With ASO, it would be different because it's acting more like a fully insured. So they would be responsible for handling how they would be doing that on their payroll. Minimum size for ASO. So basically, I will say for us at BBD, our minimum is 10, but as Jay was saying, there are a number of products in the market that go down even as low as 3. It would just be depending on whether they can meet those requirements or different things. Maybe Jay, you could comment on that a little bit more as to what you know from the industry.
Yeah, these days typically I don't have anybody who's down there. I do know there are some places where you can go down that low. Again, think about credibility. You've got to think about stop loss. You've got to think about the travel insurance contract. You've got to think about the offerings from the various providers. There's a lot to go into the thought processes. I've met very few people over the years that, under 10, it's the right thing to do. Typically, the providers that do go under 10 employees for health are not the larger, more established companies. So you've got to think about what do you give up, what do you gain if you do find one of those smaller um, providers. And that's not to say they're bad, it's just different, and understand the differences.
For sure. There's another question here for you as well. Jay, do you think people need to have a certain level of sophistication to use ASO?
I think that question applies to the client and not the advisor. And the only thing I'd say, employees won't see the difference. Employers, there's barely any difference except for the monthly billing and the ability to handle a cash flow. To the advisors, you've got a tip of the iceberg of what you need to know out of this conversation today. And I'd say if you're just entering the ASO market, you should book time with Danny to actually learn more about all the details.
Yeah, for sure. I'm always open to talking ASO to anybody, and it helps me learn too when people come up with some new questions. Um, do you find the EHC and life rates go up when you drop dental? That would vary by carrier. I would say for us, our life rates are actually not impacted by our other benefits at all, other than that particular that particular benefit. So
Uh,
if you,
and Danny,
sorry,
even your health benefit, if you just did dental ASO, it doesn't impact your health benefit either. Each of your
exactly.
premiums is individually
Yeah,
priced.
and that's one of the benefits with working with a TPA like ourselves is that oftentimes because we are working with different carriers, the rates aren't necessarily impacting on each other, and you can often just go with if you wanted just a life plan or you wanted life and EHC, that's something that's an option.
But you know,
Um,
that is a good question. If you're doing ASO with other companies, you need to ask them how they handle it.
Yes, because there are some that will be definitely a factor. I know there are other carriers as well that depending on what rates you take, it does make an impact into your pooled rate. So it's a very good question to ask. Um, so this one says pooling fees are very important to comparing ASO to fully insured. My latest fully insured renewal, 8,700 total pooled health premiums, of which 3,000 net. Sorry. Um, Okay, I don't think there was an actual question here, maybe more of a statement. Um, Meaning pooling fees are about 37% of health premium. Your rates of 17% are much more reasonable. Oh, okay, thank you very much. Yeah, we do. I would say with our one product, the ASO fees are, or the actual ASO fees are lower. We do offer through a couple different carriers, and they do have various stop loss rates. But we actually have an advisor guide if you ever are interested that provides all that information as well. Um, with BBD, is Green Shield the carrier that's paying claims for ASO? So like I mentioned, we actually work with two different carriers. So Green Shield is usually for our straight ASO products, which means the pay-as-you-go functionality. And then we also work with Claim Secure, and that's been a partnership that we've had since last June. And we work with them on budgeted ASO. And there's different varying things between carriers. So I would suggest maybe after I'll send you in particular the person who asked this question. I'll send you the ASO guide and you can take a look at that. At the end of this, I will send off basically to everyone the case study, and maybe I will just send off the ASO guide in case you'd like to look through it. And as I mentioned, if you have any direct questions, feel free to reach out to me. And I'm sure Jay wouldn't mind if you have specific questions that you can reach out to him as well um, to help you guys along. So again, I just have a couple things. So again, I'd like to thank Jay for taking his time today to share with you his methods when conversing with his clients regarding ASO. And a quick reminder before we part ways that this webinar is being recorded, and you will get an email of the recording after. And I can also make sure to include the slides with that. And you'll also receive a follow-up survey, which we would love to have you complete. Your feedback will be used to inform future content decisions and improve our events and webinars. So thanks so much, everyone, for joining, and I hope you enjoy the rest of your day.
Have a good day, everybody.
Bye, everyone.